Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pargamanik. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer, and I'm going to share my screen, Will.
All right.
While I'm doing that, if anyone's joined us for the first time, if Will and I, we do these shows in the morning to help answer questions you have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we do provide a link to Zoom on that live chat on YouTube. Click on that. When you get over to Zoom, click on the button, raise your hand at the bottom of your screen. Once we let you in, you could ask your question live and direct. If you prefer to type your question, you can type that question into the live chat on YouTube. Will's watching it. He'll read it back to me.
All right.
So, while we're waiting for more people to join us and for questions to queue up, what we'll do is start out taking a look at the pre-market report, see what's trading in pre-market hours, if we could get some insights there. If we don't get any questions, I'll default to some of the questions that I get over the email. I'll start out with that. Of course, if we do get some questions, will let me know. I'm going to try to answer those as well.
Perfect.
So, and I have like a little bit of cold, so I might sound like groggy a little bit.
Well, you sound great to us, D.
Well, I think it's allergies. Actually, this year it was my worst, I think, year of allergies, and
well, it's been terrible in our family too. And shockingly, I was unaware that dogs can get allergies based on the seasons. I don't know if you're aware of this.
No, I didn't know that.
But our dog has had a really bad reaction this spring, and they actually, they have a shot they can give the dogs, and it really helped.
Oh, yeah. Wow. I didn't know that. All right. How's your dog doing?
Good. I mean, it was a lot of sneezing, what they get is they get hot spots where they really itch, and then it gets infected, and then they itch it more, and it gets more infected. And plus, so he was doing a lot of itching, a lot of redness around the eyes, and sneezing a lot.
Yeah, that's what I've been doing. So just the warning in case I start like sneezing or something while we're doing this. So this is the pre-market report. These are stocks trading in a pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 35 stocks made our percentage gainers list, 58 on the decliners. So from this perspective, we're looking like we're setting up for a slightly bearish bias at the open. If we look through the symbols, we'll see that there are a lot of stocks in there that are small cap stocks. Here's the market caps of the stocks. We do have ETFs in there. We'll have leverage products, closed-end funds, anything that's listed on the major U.S. exchange. If it's trading in pre-market hours and it meets our thresholds, it can make this list. So what we could do now is try to narrow down this list to a smaller group of stocks. And to do that, I'm going to use the filters here up top. And this one in ETF, let's click on that. It's a drop down with a list of ETFs to choose from. And when you choose one of these ETFs, what will happen is the list below will get filtered by stocks that are holdings in that ETF. So if you're looking for like a sector ETF, broad-based ETF, we could do it from here. The SPY, that's S&P 500 ETF. So let's click on that. When we do that, the list below gets filtered by stocks that are holdings in the SPY. And here we see 3 made our percentage gainers list, 5 on the decliners. So the list, it's not huge, slightly, I would say, leaning towards the bearish open, but probably mixed bag. I think the only one that sticks out, I think Home Depot reported earnings. So they're that little E, they reported earnings. They're down 2.4% in the pre-market hours. And I think that they've seen some softening, right, in demand. And I think that's reacting to that news. So let me see. Well, if you don't have any questions, I did get a question from our friend Mike about beta. So I'll have a discussion about beta if we don't have any questions that popped in.
All right, perfect.
All right. So let me go to Microsoft here for a second. And let's start with this. Here's Microsoft. I'm going to come down here, and over here we have Microsoft and its beta. This is beta when we run the beta versus different ETFs. So this is S&P 500, SPY, the QQQ. These are sector ETFs. And then it ran it through some other technologies just to see where, the betas. And when we talk about, the beta, because these are the questions I get. Well, how come your beta is different than what I see on a different, platform, right? So you could go look at a different platform and you'll see, you could see a beta of 1.3 versus ours might be 1.2 or, and then people will try to screen by beta to say, well, if the beta is 1.2, then, if the SPY moves this much today, then I expect, Microsoft to move 1.2 times that percentage. So what I wanted to do, okay, because I get these questions, I wanted to discuss beta, like how it's calculated. What does the beta mean? Where is it coming from? Because I think that's the more important part, not just the number. Because remember, in statistics, if we use models, the models create an output, right? And the model itself doesn't know if you're using that output correctly or incorrectly. It's up to you. And for you to use it, correctly as guidance or, making informed decisions, you really have to understand that model and the limitations and how things are calculated. So let's just focus on, that discussion, because then this will become much easier for you to understand and use more effectively than just looking at this number. And these are based on questions that I get. So let's first discuss where's this beta coming from? And the beta is coming from a linear regression, simple linear regression. I'm just going to recap it here, and I'm going to draw you guys like a diagram. Right. So you get this straight line. Let me see. Can I draw a line like why is it doing it that way? All right, so let's just do this line, okay? And you're trying to predict, right? It's a prediction model, an estimate. You're trying to predict what one variable, if you change a variable, how it will impact another variable, right? So X and Y, in this case, Microsoft, we're going to do Microsoft versus the market, right? That's what you're predicting. And what you do is you take a bunch of observations, right? You'll say when SPY, moved up 1%, Microsoft moved this, SPY moved down this, Microsoft moved that. And what you're going to get is a bunch of these. observations like this around the line. Let me draw these circles. You know, you can get them below, above, like this. Okay. And then the model will tell you, okay, based on this regression, you know, I see all these little, you know, circles. I'm going to run a straight line through there. And I'm going to create this formula for you. And you guys probably remember this. Y equals mx plus b, right? So b is your constant, and then you got your variables, and this m is your slope. And that's where the beta is, right? The slope. So it draws you this slope, and that's your beta. And why doesn't everybody, first of all, get the same beta? One of the reasons is that not everybody is running the same data points. Okay. So for example, in Microsoft and SPY, are we doing daily returns, right? Daily returns? Are you doing weekly returns? You know, you could do, you know, monthly returns. So what are you comparing? Number one, because that will change the regression line, right? The regression just looks at the data, right? And if this is the data you put in, it's going to draw you a regression line. And then it's going to come up with this formula, and you're going to get a slope. How about, you know, how much data are you using? Are you using 1 year's data, you know, 2 years data, right? 5 years data? What are you using? Because that will also change your regression, and you're going to get a different equation, right? It's going to run, you're going to have different dots. It's going to run a regression, then this is going to look different, right? You're going to get and all of a sudden your slope is different. So how do you handle exceptions, right? Because then you look at the data and you're like, oh, so wait a minute, some of these days don't make any sense to me. Like, so for example, let's say you look at your data points and all of a sudden you have this, you know, way out here, then you got way down here. And then you look at it and you're like, well, let me take a closer look at these data points, right? I'm going to take a closer look at these data points. And you say, oh, wait a minute. Those are days that Microsoft reported earnings. And when Microsoft reports earnings, well, should I be using those data points? Because it's not reacting to the market. You know, it's not the market influencing that repricing. They just reported earnings, and now the firm is repriced based on firm specific information, right? That's what's going on. So do I really need them? If my regression, right? If what I'm trying to answer, if my question is how much, you know, of the market movement can explain Microsoft movement, well, those days are not relevant anymore because Microsoft is moving on its own specific news, right? It's not the market. The market can't explain it. There's a different explanation for it. So I'm going to go out and clean out my data because I don't want because that's going to affect my regression line. That's going to affect the entire equation. And I'm going to go take those out, take those data points out, and then I'm going to run and now I'm going to rerun that regression, and I'm going to get a different equation, and I'm going to get a different slope and a different beta. Okay. So so the question is, why is there a different beta? Because we don't know what other people are doing, right? We don't know what data points they're putting in. We don't know how they're cleaning their data. We don't know what exceptions they're looking at. You know, we don't know if they're looking at it at all. All we know is what we're doing. So we wouldn't be able to say our beta should match up anybody else's beta. Most likely it's not going to match up, right? Because They're most likely not doing exactly what we're doing. And if you're not, you're going to get a different beta. So, then what do we do? If we have a different beta, and by the way, it's not just beta. If you want to try to, if you're trying to use SPY to try to estimate where Microsoft should change today, you have the whole equation, y equals mx plus b, right? So you do have that constant in there too. Remember, we're talking about, this is the most simple regression line you could do, which is, just a linear regression line. I'm not talking about multi-regression or polynomial regression. This is the most simple. This is, if you're doing predictive analytics, this is kind of like your starting point, because you always try to find the most simple answer. All right. Whenever you're doing data analysis, you always try to find the most simple answer. So then, all right, so we got this regression line. We got to understand it, so what are we doing here? Well, here we're using, number one, we're using weekly returns. So these aren't looking at daily, we're looking at a week, because daily, you're going to have small changes here and there, but if you give it some time, to catch up over a week's period, you'd think like it's fully priced in. So we use here weekly, and we're looking at 1 year of data. 1 year of data weekly. Somebody else could be using monthly, daily. That, of course, will change this equation, right? We use 1 year, but you could go 2 years, 5 years. Typically, and there's no right answer. Every data analyst, every researcher will have a different opinion about, like all the relevant data that you want to use. So I can't give you like, here's the right answer. There's no right answer. And you could have different data analysts looking at the same, data, coming up with, different predictive models. But typically, in my experience, if you could use the most relevant data would be the closest, right, to the most current data, right? So the more the current data, the more relevant. The further away it is, the less relevant it is, but depending on what you're trying to measure. Okay, so the beta can change. We could see the beta over time change. The market correlation of a stock can, change, and then the beta from 2 years ago is different than the beta today. So we try to stick with the most current data. And by the way, if it's changing and you're using all those periods, it's going to impact your equation, right? The equation doesn't know that. The equation just knows these are the variables you're putting in, and it's going to just do its thing and come up with a equation for you. So it's up to you to really, make sure you're comfortable with your models, you're comfortable with the data, you're looking at the, you're looking at all the variables. It's your job to refine your predictive models. So there are things in there, I can't go into all of them, help you, with your with how good your model is, right? So one of them is the R squared. There's also p-value, but I'm not going to get into it. Let's just stay with the R squared. So in general, the higher the R square, the better your model is relative to, the explanation of one variable, right? The variability of it explaining the other. So it could be anywhere between -1 and 1. So 1 would be like that you have like a perfect correlation. The variable X is perfectly, can explain perfectly variable Y. And a -1 is inversely correlated, right? So something can be inversely correlated. If something goes down, the other one always goes up, and the other way around. So the R square becomes important because the higher your R square, the better the equation is explaining, the variability in your dependent variable. So when we look at the beta, just to get back to number one, our beta it's not trying to match anybody else's. Okay, that's not what we're doing. You're running a regression on data points, right? And it's the data points that we're doing. It's how we clean the data. It's what we deem, the data most relevant that we want to run the regression. Like I said, we do clean the data. We're looking at certain outliers where we think that that's gonna mess up the equation, and those aren't times, during earnings, for example, you're not going to try to use SPY to predict how much Microsoft is going to move after earnings, right? Earnings are a special case. So again, you're not going to get the same beta as other places, and people, reference like Bloomberg or whatever. I don't know what they're doing. I don't see what they're doing. I don't know, and I'm not trying to match theirs. We're just trying to create that, and the beta is just kind of a reference. But again, if you're trying to create models, and I'm glad you guys are asking about this, because if we get into, predictive analytics, you always want to start out with that simple linear regression. And keep in mind, when you run that regression, you do have an equation, right? MX plus B to plug it in and try to figure out, okay, if this moves this much, where do I expect Microsoft to move?
Hey, it's interesting that you're talking about Microsoft, but Sarush, who's on the Zoom, he asked, how would you represent a co-integration system with Microsoft and SPY? Thank you.
Wait, can you read that again?
How would you represent a co-integration system with Microsoft and SPY?
A co-integration system.
It's just, can you reduce the possibility that variables have a relationship that looks correlated but isn't? I guess it's another statistical method to look at relationships.
Does he have like an example? He would.
Sarush, do you have an example? Put it in there. It's also something we can explore tomorrow. If you give us the example, we can talk about it further tomorrow.
Yeah, and again, that's it's probably a good question. I just want to make sure, like, I understand what he's looking at and what he's trying to see, because I'm not exactly sure if I understand that.
They say he'll come back with an example in a few minutes, and if not, Sarush, you can email us support@MarketChameleon.com and send it over, and we'll look at it tomorrow. He also had we only have a few minutes left, so why don't you finish this up? I can take his question from earlier. Maybe we'll look at it tomorrow as well.
All right. Okay. And the other thing, what's important when we use this, right? If you use this, you're creating estimates. You don't know exactly where it's going to be. There's no way to exactly know where Microsoft is. What you're doing is using a model to help you, right? To help you estimate where you think it would be. So you could see these dots, right? If I went back into the formula, look where the formula is going to tell me, Microsoft should have been on this line. But you could see that the dots, the actual ones, are further away. So what you're doing is trying to estimate, this is the best fit line, right? It's the best fit line. That doesn't mean that you're going to hit it exactly. And then what you do is you're going to have other things in there, maybe helping you out with like standard error. I don't want to go too deep into the regression right now, because there'll be a lot to discuss, but there are limitations. You're not going to get an exact, there's no such thing as exact precision unless they're, 100%, R squared, but you're trying to estimate, right? You're using models to help you estimate where you think it should be around. And the data points, right, do not go beyond the data points. So if you use data points, like for example, if all your data points were, let's say, SPY and Microsoft, were, between -3% movements to, positive 4% movements, something like that. Like say those were all your data points, right? In those ranges. So you can't enter in -10% or +6% because your regression line doesn't know those points. Those were not even in the data sample. So don't assume that it's just gonna, you could enter anything in. There are limitations to these models. It's important to understand how to use them, because always keep in mind, the model does not know how you're using the output. It doesn't even know what your intent is, right? It just creates an output. It's up to you to understand that output and how to use it, and that you're also using the model appropriately. So for example, if I put in, well, what if SPY goes down -300%? Well, that doesn't even make sense, right? The most it could go down is 100%. So that wouldn't even make sense in the model. And the model you could put anything you want in this equation and it'll give you an answer, but you have to use it, appropriately. You can't use it in a way that does not even make sense, right? So when you're using these, beta and regression, and I think most do, but I do get questions where I'm like scratching my head and saying, huh? Like, well, what are you doing? So I wanted to discuss it. We only have a few minutes left. If you wanted to ask me that question, Will. But you're on mute.
Sorry, he didn't get back with anything. He's going to get to it tomorrow. You only got 3 minutes left. He did ask another question about, I can read it. I think we should hit on it tomorrow. He said, good morning, gentlemen. As an option writer, when it comes to open positions like naked puts or bull puts, is it better to wait for volatile news to be released than open positions, or opening positions regardless of upcoming news? So just a question he had about like selling naked puts. There you go.
Okay. Yeah, I
sent that over to you. Maybe we can look at it tomorrow. Maybe show a screen, whatever. But he's going to get back to us about the question he had earlier about co-integration systems, Microsoft. And I'll send that over to you as well.
Okay. All right. And I think that I do get like these general questions. In trading, there's no general answer to all these specific questions, because it's always like there are too many factors involved, right? There's too many variables and too many factors to analyze. So, I don't think you could just apply like a general answer, that you should always sell puts, before this news, because I don't even know what the news will be. Nobody does, right? Or, you should do it afterwards. That's why trading, it's so dynamic, it's so hard, and because if there's a right answer to apply all the time, it wouldn't even be trading anymore. You would just put it into the computer and the computer would do it for you. So it's always an analysis. You're trading, think of trading as it's data analysis, risk management, running models for valuation. It's not following some kind of general rule. All right. So trading is not like I need to have a general rule to follow. That's not what it is. You should be more of a data analyst, of analyzing the data, trying to get an estimate, an explanation, build a valuation model, risk around, models around risk management. But it's not about following some kind of general rule or, some kind of like, particular strategy, that will always win, or even a particular signal all the time. A trader is more of a data analyst than just doing trades based on, some generalization of what you should be doing.
All right. We'll end with that. Awesome job, Deem, as always. Thanks for bringing it.
All
Have a
right.
great day, my friend.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.